Good afternoon, Upper Sixth. Bullet point 5. I'm going to put a little cheeky A up there because there's so much to go through with finance. I'm going to split it into two videos for you. Now, we're going to be exploring everything from the entrepreneurs, the designers, through to the big multinational corporations trading globally. So for the finance bullets, we should really be looking at the small businesses trying to grow. And we've looked at Lunya, I think that's how you pronounce it. And they are selling through luxury locations like Selfridges and Harrods and through their website, and they're trying to grow, and they're focused on growth in established markets with lots of money. But they are in early stages, so we need to take that into account. So if we see things like their new high gearing range and negative equity, clearly there's an associated risk there. But think about what they're trying to do, what they're trying to achieve, and think about this from the perspective of the language you might use in the product life cycle. So in those introduction growth stages, it might not be about profitability, it might be more about survival. Think about those business objectives as they grow. We shall see what happens. We've got obviously the mighty Next PLC that we've spoken about before with their online, their catalogue. It's 350 pages. They still print it. I don't think they give it to everyone like they used to. We've got our pure plays, which we'll explore a little bit further. And we've got the last real big fashion holdout, as in they don't want to sell you anything online. And I had an interesting experience earlier today preparing these slides on trying to even order something online so I could pick it up for click and collect. But I'll bore you with that when we get to the slides. So you've got to think about the company's finances from the perspective of where they are in the business cycle. It could be that Lunya are trying to expand. They want to go into other locations. They want to build their B2C delivery through their websites. They want to get into more luxury. Maybe Liberties is next on their radar to grow their department store business, for example. So we have to think about that. Maybe they're going to expand into new markets. So if we think about this from a product lifecycle perspective, in the early days, they were designing their clothes, they were sourcing finance, they're relatively small. They then introduce and they're selling through department stores. Suddenly, COVID hits and they see a rapid growth in their sales because lots of people have got too much time on their hands and they want to wear something cozy and silky for bed. And then they continue to grow. COVID comes and goes, and then maybe their sales start to plateau a little bit. Is this market maturity, or are they going to market? Are they going to spend money on advertising? Are they going to continue to grow the business as much as they can? Well, this might damage their debt. This might damage their profitability. So we have to think about this in context with their business objectives. Yes, there's risk. Yes, they are a new product in a new market for this new company. We know what ASOS would say about this risk. But if it works out and they found their niche, maybe in the future, all the doubters out there, including me, might suddenly be thinking, why didn't I invest in Lunya? Or in 2 years' time, you might be going, who the hell are you, Lunya? But we shall see if they're bought up by Sports Direct. They seem to be buying everything at the moment, including possibly Currys. Hope you're watching the news. So if we're thinking about when the paper was written and then the cycle of accounts, well, as someone who used to run a small limited company, we would publish our accounts clearly. Normally within a 12-month window, to be honest with you, because you've got certain restrictions depending what you've agreed in your terms as such as a company. But it could be that some of these accounts are relatively out of date. PLCs, normally a lot quicker, and that's for lots of obvious reasons, including declaring to their shareholders. There was a PLC in the news this week that the accountants have decided that they would delay publishing their accounts because they wanted to check on some stuff to do with their German side of the business. I think their shares dropped. It was either 9 or 19% in the space of about 48 hours because everyone was panicking that something untoward was happening. So it's really important that you publish these things on a timely basis. So if your accounting question, your financial analysis question is based on a PLC, we could be looking at the end of 2022, maybe mid. If it's a limited company, it could be a year before that. No matter what, COVID is going to be a major factor. And it's really quite important that you remember that we have given you the power of foresight. You can see into the future because the future is now. And if you think about some of the success stories that might be in your paper, ASOS, Boohoo, they boomed, absolutely boomed during COVID. Share price went through the roof. Not doing so well now. Okay, so it's another one that Mike Ashley tried to buy was ASOS. So we need to think about what's happening since. However, in the future, if people decide they want to go back to shops, okay, the future is now. Just remember that. So, out of interest, when you are doing your research for this research theme, there is a wonderful website called annualreports.com. And funnily enough, if you put a company name in there, it will come up with the annual reports. Now, in the bad old days of these research themes, we might go through some accounts for you. And these are the accounts that I downloaded. So I looked at Boohoo, ASOS, obviously Associated British Foods because they own Primark, and we've got Next in there. And the great thing is nowadays you can just shove it into AI. Now ChatGPT only takes up to a maximum of 10 attachments. So I, for example, stuck all the accounts in there for Primark first of all, and I said, do me a graph to do with their sales. I wanted to see some comparative data. I've not merged it all into one because I wanted to talk about them separately. I then repeated it. The technology's out there, kids. Have a play with it. It's actually quite fun. I've been geeking out on this bullet, so thank you very much for this. I enjoyed this one a lot. Then that was the instruction I gave to ChatGPT when I did the Primark analysis clearly. And it just drew me a pretty picture after reading those documents for me. So, and there we have it. Look at that. That's a beautiful one, isn't it? So we can see, I wonder what happened here. So, yeah, that's what happens when you don't have a website. But it's also back to our previous comment, if you've watched the other videos, about the benefits of being part of a conglomerate. And when you're part of Associated British Foods and you've got troughs and buckets full of cash, and let's face it, we all ate a lot more during COVID, so the other parts of their business did extremely well. They're not going to like to take the hit on Primark sales, but they can ride this external shock. Then they still were not on the internet, and look what happened to their sales very quickly. We'll talk a bit more about that in a sec. So here's ASOS for you, and this introduces our key term, pure play. Excuse the colour, couldn't get something to match the background. So there's a definition there which I'm not going to read to you, but we know that pure plays are basically online only. And there's lots of benefits to that, but can't walk into one of their shops. So we've got some key data here, and we can see that 2018, they were just growing anyway. Then global pandemic hit, and they into the stratosphere. It plateaued at around about 2021 to 2022. And since then, Shein have been on the scene from about over here, maybe a bit more, but they're really advertising at the moment. They've been gobbling up their cheap and nasty market segments. I'm sure they sell some nice stuff. And actually their sales have started to do that. Your data will probably go up to here in the case study. However, in the future, says my MOP statement, or however, just if I want a counter argument, really, we've got to think about the market position of all these companies. Yes, it was originally as seen on screen, as per the ASOS there, and it was, popular stuff you could see in Friends if you've watched the reruns, kids. But now it's gone into more mass market, not so niche as it was before, and they've got some great customer service, fantastic reputation for building rapport with customers. Did very well in Australia with no advertising whatsoever, just because of their customer interactions. So, I'm not saying it's a bad business model. However, there's a lot of competition out there in a very similar space. Think about how they differentiate themselves. COVID really helped them, but everyone thought it was going to be the next big thing. Internet's big. Yes, internet's becoming more important, but it's not the final nail in the retailers, as in bricks and mortar retailers' coffins. So moving on to Boohoo, another pure play. Without the definition down the bottom, we can see again, I haven't got 2018 figures here because I didn't download enough of the accounts. ChatGPT did tell me off actually because I confused it. So we can see we've got a growth. We could do a percentage between there and there. We could talk about how it's starting to slow down a little bit, and Boohoo sales have sort of plateaued at the moment. Okay, if you look at 2023. Okay, rapid growth from this relatively new company, which is over here somewhere, and COVID rapid growth started to slow a little bit. Doesn't mean people aren't still buying stuff, just not buying it as much as they were before, and they're not converting more customers. Remember, new customers for Boohoo will come from either people that don't normally buy online at all, or from other online retailers. It's a very crowded space at the moment with is fast fashion. Then we go on to Next, and remember, Next have got a number of channels. So we have got the lovely Next stores that we can go in, and we saw one on Rushden Lakes that have also got a Costa and a TUI inside of it, and just down the road we've got the cinema and the rock climbing and the canoeing, or in Milton Keynes Shopping Centre, they're next to John Lewis and all the food places. So there's lots of Next out there, and it's a physical shopping experience. We've then got Next Online, and they've moved their famous Next directories obviously onto a website nowadays. In the bad old days before the wonderful world of the internet, you would go to Next and pick yourself up a catalogue, which they had stacks and stacks of them. Nowadays you can still buy the catalogues, and they are, I've found a message on Mumsnet, very reliable source of data, 350 pages. And I think they charge you a couple of quid for it, and then they'll give you the money back if you're buying stuff from them. If you're putting money on your Next account, you can get credit with Next. You can do all the stuff that you would normally do. And don't panic, this outfit is not in there. The only picture I could find online was from 1988. I remember it well. A very old Dalmatian. Clearly, they've got next day delivery. I don't think they deliver much of their own stuff. This is probably going to one of their warehouses, and then someone else will probably deliver from their warehouse directly to the customers. So, and the benefit is I can take my stuff back to the shop. I could try it on in the shop. I could look at the shop, not buy and then buy on the website. Who cares? Next are going to still make loads and loads of money. They're making a load of money online, but it's helped by the shops. So we can see here 2019 doing very, very well. I'm sure it was doing relatively well before. Something happened, no idea what that is. And then all of a sudden, COVID restrictions are lifted and bounced straight back. Okay, so, the Guardian article I've mentioned in another video, nicknaming them the cockroaches of the high street, when everyone else seems to be, dying off on the high street, they're still there, they're still thriving. They're doing very, very well. I'm sure they'll want to do better. This is not by accident. It is constant marketing and reinventing the lines and keeping in rapport with their customers and hoping that Marks and Spencer's don't start gobbling market share up again, because Next got a lot of theirs from Marks and Spencer's and other retailers. Then we pop on to Primark. This is the wonderful one at Rushden Lakes, just down the road from me, opposite Next, funnily enough. There's a load of cars between. And we can see growing, dip, something to do with the pandemic, dip a bit more pandemic, and then bounced back. Okay? And this was the queue outside of Rushden Lakes, just as everyone was so glad that they were allowed to go out and breathe fresh air and have their Primani fix. Now, quickly skipping back, you'll notice, I've been mean here, it's not me actually, it's Microsoft ChatGPT. Revenues in millions, revenues in billions. Okay? Now, I'm not saying that the chief examiner will be that mean by giving you different numbers, but you need to be able to convert between the two. If you can't, come to a maths clinic and we will help you with some basic numeracy. It's something you can just practice quite quickly. It's like reverse percentage change. You know, if they test people on that in the UK, about 80 to 90% of kids will have forgotten what they did in the fourth form. You know, I spoke to our head of maths when I first joined the school as a Dalmatian. And I said, why do my students not really understand reverse percentage change? He looked through his scheme of work for GCSE maths and he said, we spent 2 lessons on it in the fourth form. It's probably a good reason why they don't remember it, hey? They soon get reminded though. So, moving on. Yeah, this was my shopping experience at Primark. So I went in, fancied a new, whatever that is, tailored trouser suit. And it was a nightmare. My nearest place was Birkenhead. I don't live anywhere near Birkenhead. And yes, there's a minimum of £10 spend, or they can't be bothered to put it in a bag for you, which is fine. That's extra cost. This is about lean business model, a very impressive business model. They've started to let people click and collect, but the majority of the stuff I tried to click on, they just didn't have anything in stock. And that was after me putting in Rushden Lakes. Just don't show me what you don't have. Yeah. Unless it's coming, then try and sell me the perception of, you know, that wonderful anticipation that I need to have. Make sure your website works well, or customers are not patient nowadays. And not that I'm a big fan of Primani, I will not be doing click and collect with Primark. So I'm sure they'll get over it. Oh, that's a bit blurry. I do apologise. So we need to be thinking about some of those winners and losers. And this is 2022 to 2023. And you can Google this image. I apologise for it being so blurry. But we can see that lots of companies are, you know, not doing brilliantly, or it's slightly changing. So this is market share, if I'd have clipped in the graphic properly. And we can see that we've got quite a big jump for some of the new challenger brands. Now, Shein are not exactly new in the world, but they are grabbing market share away from other people. Zara has started to pick up again. Now their stores are opening, and you know it's an exciting, trendy, middle of the road brand. People tend to like it. ASOS, now remember I gave you the power of seeing into the future. We can see that there's a big drop in their market share there. TK Maxx, well, clearly they're still recovering from COVID, and you know, if you want something that's out of date and sort of designer, and if you believe that the was price was a real price, then TK Maxx is the place for you. But we've also got other budget retailers here to do with, this is fashion, by the way. It's not selling you tomatoes. Sports Direct, M&S are picking up a little bit. JD Sports, still a fashion brand, not really a sports shop, by the way. Primark are continuing to grow, and Next, it says here that their market share is the same. I'm sure if I checked another source, it might slightly disagree with that. But we can see that some of those, it's a shame this hasn't got Boohoo on it, but some of those are not doing so well. Okay, sportsdirect.com, if that said Fraser's Group, then I'd be a bit more excited because they've got a number of different brands in there that we would like to track. Pretty good indication, though, of what's happening to ASOS, Marks and Sparks and stuff like that. Okay, during lockdown, massive shift online. Quickly summing the data up. ASOS shares, Boohoo boomed. COVID was okay for Next. They sort of did all right in comparison to some others. M&S's online business is not that strong. It grew a little bit, but if you think about how much they lost from the stores, it was not very good. And obviously Primark did not do well because they couldn't sell anything. Many of us assumed that this was going to be the new normal. I remember having a guest speaker in during COVID, very bullish about online retail, and that lots of the high street retailers, be that on shopping destination places like Rushden or on good old Bedford High Street, it was going to be the end of them, and it was sort of right. So if we look at share prices, there's a big difference. Okay, so we can see it's all about supply and demand. We know where share price comes from, and we can see there is a jump because people think the pure plays are going to be doing brilliantly. Lots of people thought that Next were doing brilliantly in the same period as well. They were growing their online business and they had the stores, and they're that tried and trusted brand that we know and love from over the ages. So we saw quite a big jump between, 2019 and June 2021. 12 months later, it was a totally different story for some of them. We could see, you can do the percentage change between that if you want to. That is a crazy drop. Something drastic happened at Boohoo. Okay, suddenly a weak company, not a lot of capital value, quite vulnerable for possible takeovers, and who would have guessed it, hey? ASOS, similar story, bit of a slower decline. And even though this is January 2024, things are still, they're slowing down how much they're declining, but ASOS is still struggling. Okay, Boohoo down to 39 pence, and the mighty Next. Clearly, the investment bankers and the pension funds like that one. You can pause if you want to, and do a percentage change between 2019 and 24. This is the sort of thing that you could do. You could do a short-term range, a longer-term range, practice your percentage changes. You see numbers, you do a calculation. Here's one I did earlier. So minus 88.5, yeah, speaks for itself. Okay, bricks and mortar, multi-channel retailing at the moment seems to be the way forward. However, are Next the cockroaches of British High Street? Are they the exception to the rule, and the majority of others aren't doing very well? Well, look at Sports Direct, Fraser's Group. They're gobbling up all the struggling retailers into a massive brand portfolio. Mike Ashley seems to have this golden touch. Yeah, the press may not like him. However, we all talk about him, and he's doing an exceptional job. And if he picks up Currys, then he's got one of the biggest electrical retailers under his belt as well. Okay, so we have to think about why he's doing that. Maybe Currys, Game, and all the clothing places. And suddenly he's got all these ex-Frasers or House of Frasers department stores that are suddenly going to have Currys in them as well. True department store experience again, when there's not a lot of that on the high street. But then again, Look what's happening to John Lewis. We shall see. And let's go on to Lunya. Okay, let's think about this company. Now, first of all, they're an independent company, and their business is of such a size, they only have to publish limited accounts. They can publish more if they want to, but they're not listed. They're not trying to drum up too much investment. So, you know, they're following what they need to. Okay, so you can pop on to Companies House and download their published accounts. And I apologise for changing the headings of the descriptions for their clothes. But it's quite scary when you just look at the numbers and you think, I wouldn't even make them a pair of trousers if I was a clothing manufacturer, because they look like they're so fragile. They look like the business is going to collapse next week. However, they're a growing business. Think about this from the perspective of the product life cycle, for example. They're in their introduction, early growth stage, and maybe their main priority is not profitability. Do not default to profitability in your chains of argument, TikTok fans. So looking at some of their accounts, for example, we've got a good range of numbers here. I don't think you'll be given 4 years worth of numbers in the paper. They normally give 3, sometimes less, but you never know. Here's 4. Obviously, brackets around numbers are negative figures, or in this case, money that they are owed. So it's negative from the accounts in some ways. They haven't got it, but they're going to get it soon. Hopefully, we'll be fine. So if we think about key definitions in here, we've got debtors. Okay, so the entity who owes money, okay, as in the borrowers, they owe this money in some ways. So we need to think about that. I've got cash. Now this is liquid cash. This could be cash in hand. This could be cash in bank. And some accountants might class this as something that can be cashed in possibly within 30 days. So it could be something that's available to pay accounts. Now, because this is a new company, they might be paying for things by cash. I doubt it. They're probably paying for things on a 30-day account. They're not big enough to turn around to the big international suppliers and say, I'll pay you once every 6 months. Now, if they are supplying through their supply chain to Selfridges and I was about to say Halfords, I'm sure they're not, to Harrods, then I don't think that they will be paying them within 30 days. Sometimes this can be a killer for small businesses, especially if they've got liquidity problems, because if this company has got, I don't know, £600,000 worth of invoices outstanding with Harrods, well, Harrods may not pay them for 6 months, and then Harrods might pay them late. Now, these guys might, Lunya might have to pay their suppliers within 30 days. That means they've got 5 months of stuff that they've already paid, they don't have in stock, they can't sell it again. That's if they sell it immediately. Do they have a warehouse full of this stuff waiting to be sold? Well, we would argue that they might, when we start talking about these numbers, they might have a warehouse just full of clothes waiting to be sold, and then they still have to wait 6 months for it. I'm hoping the markup is ridiculously high, but remember, Harrods and Selfridges need their markup as well. So creditors, the entity who is owed money. Yeah, so we know that they basically are owed quite a lot of money from their supply chain, which is fine. That's just the way it is. And they're lending money to other people in some ways. So we are thinking that 30 days versus 6 months, very important. Keep an eye out for that in the case study, because if they want you to have that, they'll probably give you it. They'll mention credit terms. We've then got the formulas. We're not going to work through the calculations here. If you don't know how to calculate this, well, you need to memorize the formulas and practice. And we've got current ratio there as well. Pause the video, calculate. Then we can go on to actually having a look at some of this. We've got to think about, is this a good figure? Well, this might be a good figure for a supermarket, for example. And if they're selling perishable goods and they know roughly how much they're going to sell, they've got turnover. This is a fashion business. This is a fashion business that has got quite a lot of debt, and their liquidity and their asset and current ratios are clearly not going to be brilliant. This will need to be improved over time. One of the reasons why this is very important is fashion's a fickle business. If you get the trend wrong, then you're going to have problems. Remember what I said in a previous video about someone who I know who used to work for Matalan. She based buying coats on weather forecasts. The weather forecasts were wrong. They then had to sell all the coats off very, very quickly and cheaply just to not get stuck with them. The reason for that was next year the trend would change because of fashions and fabrics and patterns and colours. So you've got to take all that sort of thing into account. Now with Lunya, a pair of grey silk pyjamas at 300 quid, maybe plain silk will be in fashion next year. They might get away with it. However, if they want to sell me a new pair of pyjamas every year, maybe for Valentine's Day, my wonderful wife might want to buy me a new pair of pyjamas, for example. Maybe they need to bring new stuff out every year, which means the old stuff is old. Maybe that gets put into the Black Friday sale or something. Don't know, but you've got to go very, very careful. Now, we can see that this has started to improve over the years. So there is a success story here in a growing business. Maybe liquidity ratios improve over time, however, in the future. Yeah. We can also see that they've taken some decisions probably to hold less stock. So you've got to take that into account as well. And we can see that this figure has reduced significantly over time as well. Okay, so they are getting better in lots of ways. We've also got a big improvement in cash, or that liquid cash in bank, cash in hand type thing. So this is growing pains possibly of a new business. Okay, really important to talk about where they are in that product life cycle stage as a business. So then we're going on to gearing. Again, we're not going to walk through the calculations here. We'll have a quick look through some of the formulas and the concepts. So think about this. We've got those up there. We need to know what equity is. Thank you very much to Investopedia for this one. And capital employed, you'll need to know how to calculate that. And then we can look at how much profit they've made. Even though we weren't given profits, you know, if we've got obviously those cash reserves or reserves it would be there, then we can work out the difference between the years. So they made a positive profit that year. They made a positive profit that year. We could do a percentage difference between the years. However, if this continues in the future, things will be better. So we can see they've got a positive figure here, but it's gone down quite a lot here. Well, simple work of a calculator, we can work out that they've actually lost some money that year, and then we would want to know why. Okay, looking at the gearing ratio, we've got 185%, and the lowest is 79%. Now, because this is a small business, and this is where your forms of business knowledge might be a little bit lacking because of the textbook, which is a little bit lacking. Now, we are told that once you're a limited company, you've got limited liability, which is true, unless you sign your right away to that limited liability with your bank. Now, banks won't loan you money, and some companies won't actually give you trade credit if they think you're too much of a risk. So I don't know, but I'm guessing that this company is so indebted, so new, that banks or suppliers might ask for personal guarantees. Okay, this could be against the original shareholders' personal assets, their houses, maybe they've got personal guarantors for loans or something. Not quite sure. But running on this sort of gearing ratio is not sustainable. Now, yes, they've gone into the positives at the moment. If they continue with this growth, then hopefully it'll all work out for them. But you need to think about how much potential risk there is in this business model as it's in the early growth stages of the product life cycle. If they are borrowing from the bank, then they might be paying a high percentage in interest and have to put personal guarantees. When I was a young puppy, I had a small business and I went to HSBC that we'd been banking with for probably about 10 years. I'm an old puppy. And they said to me, yes, you can borrow this money because I wanted to buy some more property, but we used to guarantee it against your house. And I went, well, no, we've been with you for 10 years. And they went, well, we've assessed the risk. And I thought, well, no, it's just HSBC trying to stitch me up. So I then went to Barclays, offered to move all my business banking over to them, and Barclays gave us the loan and a deal on business banking. And we didn't have to use the personal guarantee against the loan. Lots of small companies have to. Now, is this a bad thing? No, because if you don't have the money, you can't work. Okay, and that's the choice probably Lunya have had to make. So understanding that not all limited companies have limited liability because of this example might be something to take into account if you see this level of debt in a business in the early stages of the product life cycle. Other things, they've reduced their staffing count. That'll bring down their costs. This term means that, okay, so that's what I've just been explaining on their own personal assets. And this is literally lifted out of Google, as you can see by the formatting. Is it good or bad? Well, it could be bad. If the company goes bust, they're going to take your house with them because you don't have limited liability, but maybe they don't take everything because you've only guaranteed your house. And remember, it's that opportunity cost. If I don't have the money, am I still able to grow? Now, this company is probably hoping for maybe a Liberties contract or the equivalent in the United States. Now, if they want to grow into a new market, they're going to need stock. Now, it might take 6 months to get that money. And if they don't have the stock, then they can't get the big national US department store contract, for example. And that means that their business will stay small. Well, reasons to stay small is a Theme 3 unit. This might not be the business objectives of this company. Okay, I think we're nearly there. We are. That's the end of that first video, which seemed very long, but there's a lot there. You can see there's lots to be excited about here. Do some research. Go and download some accounts from that website that I've mentioned earlier. Have some fun with this. And if you're scared of maths, just practice. It's easy. It's grade 4 GCSE on a good day. But if you don't practice it, you're going to fumble, you're going to mess your timing up, and you're not going to get the grade that you need. Using the data in extract, whatever it is, means if that data extract has got numbers in it, you better do some calculations. So remember the formulas. It's only February. You've got plenty of time.